I'm Hoodie Econ Man, and this is my channel, Hoodie Economics. Thanks for tuning in today. Today, we're going to talk about why stock markets go up when the economy goes down, and stock markets go down when the economy goes up. So let's get into it. To start to explain why this happens, we need to understand what a stock market does. And the stock market does a lot of things, but basically, taking away a lot of the noise, the point of the stock market is to fairly value what a company is worth. And the stock market does this by taking the company's projected future free cash flows and discounting them by a discount rate and, saying that today that's, the present value of the company's future free cash flows. That's how a company is valued, discounting its future free cash flows and adding up all those future free cash flows. So that can be explained by this formula right here. So if we say X is the value of a company today, 100 is its future free cash flows, total future free cash flows. We're going to divide that 100 by its discount rate, and we're going to get the value of the company today. So I realize this might be a little confusing if you don't know what a discount rate is. So discount rate you can think of as basically a quantification of the risk of a company. Now, the risk of every company is based on the 10-year Treasury yield. That is a baseline risk for each company in the economy. So the 10-year Treasury yield basically represents the risk of the US government, or the risk you need to, that rate compensates you for the risk of the US government. Collapsing in a sense, I know the US government basically can just print enough money to pay you back. The idea is there's a 3% risk or a 4% risk right now that the US is going to have to print a crap ton of money and devalue all the money it owes you. That risk represents the 3% rate you're paying on a 10-year right now. So similarly, the discount rate represents the risk the company is basically going to go under, and it's the risk you have to be compensated for to buy that company. So obviously, if the risk of that company going under decreases, that company is going to be worth more. Similarly, if the risk of that company increases, that company is going to be worth less. So that's a general overview. We can think of a discount rate being broken up into two things. It's equal to some combination of that company's risk and the overall market risk. Now, the overall market risk is just anchored by the 10-year yield rate. So the higher the 10-year is, the higher the discount rate is going to be. And basically, if a company's risk profile doesn't change at all, if the 10-year goes up, that indicates everything's more risky all of a sudden. The discount rate's going to go up. So if the discount rate goes up because rates go up, all of a sudden, this thing is worth less. Not worth less, but worth less than it was. Okay. So now let's get into what's happening. Basically, what happens when the economy goes down is investors expect the government to lower interest rates or keep interest rates low, close to zero. So rates stay near zero. And if we think of the investable financial instruments you have basically have equities and you have debt. I know you have a whole lot of things, but let's just simplify to that. Debt, basically, you give someone a loan and you expect an interest payment back at a periodic time, right? But if rates go near zero, all those rates on the loans you give out are based on the 10-year yield. So the lower the 10-year yield is, the less yield you can get on these debt instruments. So when rates stay near zero, debt instruments have less interest payments. Let's say have smaller interest payments and are thus less attractive. So if you're like a PIMCO, you're a BlackRock, what have you, you need to get some return for your customers. And if debt instruments aren't doing it, you got to look elsewhere. Where's the clearest, most obvious place to look? The stock market. Basically, you can't get returns on your debt instruments. You need to put your cash somewhere. You got to put it in the stock market. And when you get more cash in the stock market, what happens? So let's see. Rates are near zero, right? So these values are as high as they're going to be because the discount rate is pretty low. right? So the lower the rates are, the lower the overall market risk is, the lower discount rates are going to be. For each company is going to be valued more. So when each company is valued more and we have more money flowing into the stock market, i.e. supply demand, right? The supply stays the same, demand is increasing because there's more money chasing the same stock. The stock market is going to appreciate, i.e. go up. All these companies are going to be worth more money. There's more money chasing all these companies, and because of lower discount rates, each company is worth more. Now, in a typical economy or a typical economic cycle, let's not think about too much what's happening right now with COVID. As the rates are supposed to stimulate action in the economy. People are start to lend money more, or take risks, what have you. So low rates are supposed to stimulate the economy. What happens when the economy is stimulated? It starts to move faster, 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 faster. As the economy is moving faster and faster, what's happening? We have the potential for inflation. So basically, as things are loose, people might, do too many economic actions, prices might go up. And central banks realize this, and because of this, they want to push up interest rates. So as the economy gets better, you want to push up interest rates so things don't overheat. What happens when you push up interest rates in terms of the stock market? Let's look here. So firstly, every stock is suddenly worth less, not worth nothing, but worth less than what they were worth before. Basically, if we look at this equation right here, overall market risk is going up, i.e. the 10-year yield is being risen because the Fed or the central bank or what have you is raising rates. So even if the company's risk profile didn't change, the discount rate is going to go up. So if the discount rate goes up for every company, company is now worth a little bit less than it was before. So that's something, right? And the second thing is these debt instruments that used to not be attractive, well, their interest rates are based on the 10-year yield. They're suddenly more attractive now. So now let's say I'm a PIMCO or I'm a BlackRock. I look at the stock market. All right, so the low interest rates and thus the low discount rates justified these sky high valuations I was seeing for stocks. Now all of a sudden, what's happened? The Fed raises rates and stock values don't make sense anymore because the current stock values that BlackRock or PIMCO is looking at immediately after rates rise are based off of lower discount rates. So as discount rates go up, all of a sudden all these stocks are overvalued. And PIMCO and BlackRock are saying, hey, these debt instruments are yielding some return. Let's go there instead. Those are less risky than an overvalued stock market. What does that lead to? Money leaving the stock market into the bond market. And when money, so we have two factors here, right? Now all of a sudden stocks are overvalued individually because their discount rates have gone up. But we have a supply demand issue, right? There's less demand because people don't want to be stuck holding an overvalued commodity. So money leaves the system, demand lowers, and that also puts negative pressure on prices. So that's why that sums up the video. That's why when the economy is doing badly, markets do well, and when the economy is doing well, markets do badly. Thanks for listening. Hopefully, this is the first video in a long and successful YouTube career of me explaining to you financial topics I find interesting. Please hit that like button and please hit that subscribe button if you're interested in following me in this journey. Thanks so much. I appreciate it. Have a good day.